Disclaimer. This analysis is for entertainment purposes only. Consult a professional for your specific case.
Always good to get that right out of the way.
Right, exactly. So if you look at the enterprise software market right now, you have this incredible, almost unprecedented financial paradox playing out with one of the biggest names in the space.
Oh, absolutely. It's a massive contradiction.
Yeah. I mean, you're looking at a company that is fundamentally dominating its environment. They are landing record-breaking 9-figure contracts. They're rolling out these AI tools that developers are just adopting at breakneck speed, right? Top-line revenue is surging past $4 billion.
Yep.
But then, you lift the hood on the financials, and they are bleeding cash. I mean, a massive $1.3 billion net loss in a single year.
Which is it's the ultimate tension in modern tech investing, right?
Yeah.
You have a machine that's operating at peak performance on the sales floor, yet the structural costs of maintaining that performance and defending their territory are just staggering.
And that is exactly the paradox we're tearing apart today. We are doing a comprehensive investment thesis on Snowflake, ticker symbol SNOW.
Yeah, we're really getting into the weeds on this one.
For sure. And just to lay out our sources for this deep dive, we're pulling from Snowflake's Q4 FY 2026 earnings transcript and their investor presentation. We've got some financial metrics from Fintel and Simply Wallsaint and a really eye-opening competitive analysis from Forge Global.
Yeah, that Forge Global report really puts things into perspective.
It really does, because our goal here isn't to just read back the latest earnings report to you. We're going to look past all the AI hype, figure out the actual mechanics of why their business model is under siege right now, and determine the true intrinsic value of the company.
Right.
By the time we're done, we'll have a calculated verdict on whether this stock is a buy, hold, or sell based on where it's trading today.
And to really grasp how Wall Street is pricing Snowflake right now, I mean, we have to start with the tectonic shift happening at the very foundation of their business. Because the ground they built their empire on is, well, it's fundamentally moving.
Right, because historically, Snowflake's entire pitch was about being this, ultimate, highly secure luxury vault for a company's data.
Exactly, the proprietary cloud-based data warehouse.
Right. The deal was simple. You take all your company's structured data, you ingest it into Snowflake's proprietary vault, and then you pay them to store it and compute it. And because it was in their proprietary format, the switching costs were just astronomical.
It was the ultimate competitive moat. I mean, once your enterprise data was locked into the Snowflake ecosystem, migrating it to a competitor required completely rewriting all your data pipelines.
Which nobody wants to do.
Nobody. It was too painful and way too expensive to leave. But that entire paradigm is collapsing now. The industry is rapidly shifting toward this open by default standard, and that's heavily driven by open source table formats like Apache Iceberg.
Okay, I want to pause on Iceberg for a second because this is the critical mechanism of the whole shift, right? Iceberg essentially decouples the storage from the compute engine.
Yes, that's the key.
So instead of a company handing their data over to be locked in Snowflake's proprietary vault, the company just keeps their data in their own cheap open cloud storage, like an Amazon S3 bucket, right?
Right, exactly.
They format it using Iceberg, and then they just point Snowflake's compute engine at it when they want to run queries.
Which means the vault doors have essentially been blown off the hinges. I mean, if a customer is keeping their data in an open format in their own storage bucket, that switching cost drops to near zero.
Wow.
Yeah. If they get annoyed with Snowflake's pricing, they can just point a competitor's compute engine at that exact same data tomorrow. The storage moat is evaporating in real time.
So if storage is becoming this cheap commodity and they can no longer trap the data, Snowflake has to win somewhere else, right? I mean, they have to win on the intelligence layer.
And that is the existential pivot they are making right now. Because if you can't lock the data in, you have to provide the absolute best, fastest, and most intuitive AI tools to analyze that data wherever it happens to live.
Right.
Which is why we are seeing them pour just incredible amounts of capital into AI.
Yeah, like that $200 million expanded partnership with OpenAI, right? To integrate those native models directly into the Snowflake platform.
Exactly.
And they are pushing out products so aggressively. They launched Cortex Code, which helps developers build AI apps faster, and Snowflake Intelligence, which allows business users to essentially query their data using natural language.
Yeah, and the adoption numbers for those look solid on the surface. I mean, Snowflake Intelligence accounts nearly doubled quarter over quarter, hitting about 2,500 accounts.
Yeah, I mean, that is a strong quarter-over-quarter growth rate for a new enterprise tool. But I kind of have to push back on the scale of
Yeah.
that, right? Like 2,500 accounts is kind of a drop in the bucket for a company valued at around $60 billion. Is that adoption actually moving the needle, or are they just running as fast as they can because they're terrified of the massive elephant in the room?
Oh, it's heavily the latter. I mean, they are sprinting because that elephant is Databricks, and the competitive shadow that Databricks casts is just enormous.
The Databricks duel is wild to me. The competitive analysis from Forge Global paints a staggering picture. Databricks is still a private company, right? But their recent funding round pushed them to a $121 billion
Yeah, they
valuation.
are massive.
And they just announced a $5.4 billion revenue run rate. Like, to put that in stark perspective for you listening,
Hmm.
Databricks has officially overtaken Snowflake. Snowflake's market cap has been fluctuating between, what, 59 billion and 92 billion.
Yeah,
And their FY26 revenue was 4.47 billion. Databricks is officially the bigger beast now.
they are. And the reason Databricks is winning right now comes down to the types of data they handle. You see, Snowflake historically dominated structured data. So think like clean spreadsheets, CRM records, financial ledgers.
Right, the neat and tidy stuff.
Exactly. But Databricks built its DNA on unstructured data, raw text, logs, audio, video.
And unstructured data is the exact fuel that large language models and AI systems need to train on.
Precisely. As the entire enterprise world pivots to AI, the volume and value of unstructured data have just exploded. Databricks was already positioned where the puck was going. So Snowflake is now having to aggressively build or buy their way into that unstructured AI-heavy workload space.
Which raises a huge red flag for me about Snowflake's consumption-based business model.
How so?
Well, if Databricks is capturing the most lucrative AI workloads and the open data movement makes it effortless for customers to route their queries to Databricks instead of Snowflake, isn't a consumption model incredibly vulnerable?
Oh, absolutely.
Like, if a client only pays for the compute credits they consume and they decide to just consume them over at Databricks, Snowflake's revenue literally shuts off overnight.
And management is acutely aware of that vulnerability. It's why they aren't just relying on organic growth. They are literally buying their way into deeper integrations. Look at their recent $600 million acquisition of Observe.
Okay, what's the play there?
They're trying to break into the IT operations and observability market. They want to monitor the entire data pipeline, not just process the queries.
Ah, basically embedding themselves deeper into the IT infrastructure so they aren't just an interchangeable query engine.
Yes, and beyond acquisitions, they're actively exploring standalone software subscriptions for these new AI tools. They realize that relying purely on consumption in an open data world is just too volatile.
Right.
They need to lock in predictable, recurring revenue streams to stabilize the ship.
So, okay, if Snowflake is forced to buy companies for 600 million just to defend their turf against Databricks and drop hundreds of millions on open AI partnerships, how is that bleeding into their balance sheet? Because the sales numbers they just reported look fantastic, but the bottom line paints a very different, much darker picture.
Yeah, the divergence between the top and bottom lines is where this investment thesis gets truly complicated.
Yeah.
Because on the top line, their sales execution is undeniably elite.
I mean, Q4 FY 2026 revenue hit $1.23 billion. That is up 30% year over year. For the full year, they brought in $4.47 billion. And they're landing whales, too. They secured a record-breaking contract worth over $400 million.
Yow.
Yeah. They've got 733 customers spending over $1 million annually. But the metric that really stands out to me is their net revenue retention, their NRR. It's holding incredibly steady at 125%.
Which is the magic of a consumption model when it's actually working in your favor.
Right. Explain the mechanism there for us, because 125% NRR doesn't mean their sales team went out and sold 25% more software seats to the same company, right?
No, not at all. In a consumption model, customers buy a pool of compute credits. As a customer's business grows and as they run more complex queries, especially resource-heavy AI queries, they burn through those credits faster.
Makes sense.
So they naturally have to replenish and buy more just to keep their daily operations running. So Snowflake's existing customer base is organically spending 25% more this year than last year, largely driven by increased data usage, not necessarily new sales pushes.
It's a beautiful compounding engine on the revenue side. But let's look at the actual cost of running that engine, because according to the Simply St. Beta, despite pulling in almost $4.5 billion in revenue, Snowflake posted a GAAP net loss of $1.33 billion for the year.
Yeah, it's a tough pill to swallow.
That is an earnings per share of negative 3.95. How do you lose over $1 billion when your customers are automatically spending 25% more every year?
Well, the primary culprit driving that gap loss isn't server costs or even the OpenAI partnership. It's stock-based compensation, or SBC.
Ah, the classic Silicon Valley accounting trick. Let's really break down how this works because it heavily distorts how healthy this company looks to a casual observer.
Right. So tech companies, especially in highly competitive fields like AI, they have to fight viciously for top engineering talent. Instead of draining their cash reserves to pay massive salaries, they pay a huge portion of compensation in company stock.
Right. It's like running a booming city, but instead of paying your builders in cash out of the treasury, you just keep printing new deeds to the city's land and handing those out.
I love that.
The city looks incredibly wealthy on paper because the bank account is completely full, which is exactly why Snowflake's free cash flow looks so positive. But every existing citizen's slice of the pie gets diluted.
That is the perfect analogy. And from a GAAP accounting perspective, issuing those deeds has to be recorded as an expense on the income statement, which completely crushes their profitability metrics and drives that $1.3 billion loss.
Wow.
Now, management is attempting to rein this in. SBC was a staggering 41% of their total revenue in FY25. They brought that down to 34% in FY26, and their forward guidance aims for 27% in FY27.
Okay, so the dilution is slowing down, but 27% of revenue going to stock compensation is still a massive anchor on profitability. And what about their actual product margins? If they're shifting away from their highly profitable storage vault and leaning into AI tools, what does that do to the unit economics?
Currently, their non-GAAP product gross margin is incredibly strong at 75.8%.
That's solid.
Very solid. It's a highly lucrative business today. However, we do have to monitor the margin profile of these new AI products. Computing large language models is exponentially more expensive than running standard SQL database queries.
Right, the compute power is insane.
Exactly. As tools like Cortex Code and Snowflake Intelligence become a larger percentage of their overall revenue mix, it is almost certainly going to put downward pressure on that 75.8% gross margin.
Okay, so let's synthesize this. We have a business whose structural storage moat is being actively dismantled by open source formats. They are in a brutal, very expensive cage match with Databricks for unstructured AI workloads. They are growing top-line revenue at 30%, but losing $1 billion on paper because they're essentially printing shares to pay their engineers.
That about sums it up.
Given all that turbulence, how on earth is Wall Street valuing this stock today? Like, let's dive into the valuation models, the multiples, and this massive disconnect we found in the intrinsic value calculation.
Well, the pricing of Snowflake right now is highly polarizing, depending entirely on which metric you prioritize.
Let's start with the surface level multiples. The stock is currently trading around 174.40. That gives it a forward PE ratio of 97.59.
Which is high.
Very high. But the price to sales ratio, the PS, is the one that really highlights the premium. Snowflake is trading at 12.6 times its sales. If you look at the broader US IT industry, the average is just 2.1 times sales. So relative to his peers, you are paying an exorbitant premium for every single dollar of Snowflake's revenue.
Right. And if you look at their historical PE averages over the last 5 years, it has always traded at a steep premium, largely because the market was pricing in flawless execution and an impenetrable moat.
But the moat isn't impenetrable anymore. Yet, despite the astronomical multiples and the massive Databricks threat, analyst sentiment in our sources remains overwhelmingly bullish. I mean, out of 44 analysts tracked, the consensus rating is a strong buy. Their average price target sits between 244.83 and 247.30.
Which represents an upside of over 40% from its current trading price.
I don't get it. How do 44 professional analysts look at a company trading at 12 times sales with a negative GAAP EPS of almost $4 and slap a strong buy on it?
They justify it through the 10-year discounted cash flow analysis.
Okay.
Wall Street isn't looking at the GAAP losses today. They are modeling the cash generation potential of that consumption model over the next decade.
All right, let's dig directly into the inputs of this DCF model from Simply Walson because the assumptions are doing a lot of heavy lifting here.
Definitely. So the DCF utilizes free cash flow as the base for the analysis, which, remember, looks very healthy because they pay everyone in stock instead of cash. The model projects a 10-year period using a 9% growth expectation for operating earnings.
I'm going to stop right there. 9% operating growth every single year for a decade. That assumes they don't get dragged into a massive price war with Databricks, and it assumes their AI products command high enough margins to offset the commoditization of their storage business.
It is a very aggressive assumption, yes, but it aligns with the stickiness of their existing enterprise contracts and that 125% NRR we talked about.
Fair enough.
So after that 10-year period, the model applies a terminal growth rate of 2.5%, essentially assuming the company matures and grows slightly above inflation forever. Finally, it uses a 10% discount rate to account for the risk and the time value of money.
Okay, so when you plug all those future cash flows, the 9% growth, the 2.5% terminal rate, and the 10% discount rate into the formula, what is the final calculated intrinsic value of the business?
The intrinsic value comes out to 253.50 per share.
That is a wild disconnect. The stock is trading around 174, but the mathematical model of their future cash flows says it should be worth over 253.
Exactly. Which means despite the PS multiple of 12.6x making it look terribly expensive relative to the industry, the DCF model suggests the stock is actually trading at a massive 31.7% discount to its true intrinsic value.
Wow.
Yeah. This tension looking wildly overvalued on relative multiples, but deeply undervalued on an absolute cash flow basis, is the entire crux of the debate.
So if you're a potential investor looking at SNOW right now, you really have to weigh this heavy discount against the very real structural threats to the business. To deliver a final verdict, let's look at how the smart money is playing this exact tension. What are the institutions and the insiders doing?
Well, the ownership data reveals a pretty stark split in confidence. Institutional investors are completely bought in. Institutions currently own 79.24% of Snowflake.
That's huge.
Yeah, we're talking about massive asset managers like Vanguard and BlackRock actively adding millions of shares to their positions. They clearly believe the DCF model is the accurate reality.
But the people actually inside the building are painting a different picture, right? The insider trading data from Fintel over the last 30 days is heavy on the sell side. Insiders sold almost 79,000 shares, worth about $13.84 million. And we aren't just talking about mid-level directors liquidating some stock to buy a house. We are seeing recent sales by the founder, Benoit Dageville, and the chief accounting officer, Emily Ho.
Right. You always have to view insider selling with nuance. Executives sell for tax purposes, or through pre-scheduled 10b5-1 trading plans to diversify their wealth. And insider selling doesn't automatically mean the ship is sinking.
Sure, that makes sense.
However, the sheer volume of selling recently, contrasted with a complete lack of open market insider buying, suggests that the people running the company aren't viewing that 174 price tag as a massive, unmissable discount.
It certainly makes you question that 40% upside the analysts are projecting. So we've laid out the entire landscape here. We have the evaporating storage mode driven by Apache Iceberg. We have the fierce Databricks duel over unstructured AI data. We have 30% revenue growth masked by a billion-dollar gap loss due to stock dilution. And we have a stock that looks expensive against its peers, but cheap against its future cash flows. So, what is the final definitive verdict? Buy, hold, or sell?
Well, if we base the verdict strictly on the current stock price's premium or discount to the calculated intrinsic value from the DCF model, the verdict is a BUY.
Okay.
At roughly 174, the stock offers a 31.7% margin of safety against the fair value of 253.50.
So if you're holding SNOW right now or considering jumping in, you really have to ask yourself, do you buy into Celio Sridhar Ramaswamy's vision? Do you believe Snowflake can successfully pivot from being a proprietary data vault into the foundational control plane for the new AI era?
That's the billion-dollar question.
Literally. If you believe they can out-innovate Databricks on the intelligence layer, then that 31% margin of safety makes this a highly attractive entry point despite the gap on profitability.
It is a classic growth at a reasonable price setup. But that reasonable price entirely depends on the durability of their new AI moat. And before we wrap up, there is one final, larger structural question that this analysis leaves hanging, and it's something anyone investing in software really needs to consider.
Oh, I love the blind spots. What's the existential threat we haven't priced in?
Think about the massive transition Snowflake is currently undergoing. They are spending hundreds of millions of dollars on AI tools to replace the structural moat they lost when open data formats commoditized their storage business, right?
Yeah.
So they are betting their entire future margins on being the smartest intelligence layer that sits on top of your data.
Makes sense. If they can't charge a premium for storage, they have to charge a premium for the brain analyzing the storage.
But look at the broader AI landscape. Foundational models from OpenAI, Google, Anthropic, and open source models like Meta's Llama are advancing at a blistering pace. They are becoming incredibly powerful, ubiquitous, and frankly, interchangeable. The cost of running complex AI reasoning is just plummeting.
Oh, I see where you're going with this.
What happens to Snowflake's margins and their newly built AI moat if the intelligence layer itself becomes just another cheap commodity in the next 5 years?
Wow.
Right. If every enterprise has access to near infinite, dirt cheap AI reasoning through open source models, how does a data platform justify charging a massive premium for their proprietary intelligence tools?
That is a terrifying thought for any software investor. Like, are they just running desperately from one commoditized market right into another?
Exactly.
If intelligence becomes as cheap as storage, the entire consumption model breaks down. That is a massive paradigm shift you absolutely need to mull over if you are allocating capital in this sector.
It's definitely something to watch.
Well, thank you so much for joining us on this deep dive. Keep questioning the assumptions behind the DCF models. Keep digging into how these companies are actually paying their engineers. And remember, just because a company is growing top-line revenue at 30% doesn't mean the foundation underneath isn't shifting. We'll catch you next time.